Welcome to the June episode of our IASB Update podcast, where we bring you the latest news from our recent IASB meeting. I am Nili Shah, Executive Technical Director of the IASB. And joining me today are Linda Mezon-Hutter, Vice Chair, and Hagit Keren, one of the IASB board members. So welcome. It's nice to have both of you here.
Well, it's nice to be here with you, Hagit. Thank you.
So, in June, the IASB discussed 8 projects. And in this episode, we will focus on 3 of them. The first will be climate-related and other uncertainties in the financial statements. The second will be financial instruments with characteristics of equity. And the third will be provisions, targeted improvements. So let's start with our work on climate-related and other uncertainties in the financial statements. As listeners may know, the IASB started this project in 2023 because of stakeholder concerns that information about the effects of climate-related risks in the financial statements was sometimes insufficient or appeared to be inconsistent with information a company provides outside its financial statements. To address these concerns, the project aims to explore targeted actions to improve the reporting of the effects of climate-related and other uncertainties in the financial statements. In July 2024, the IASB published an exposure draft proposing illustrative examples on how companies can apply IFRS accounting standards to report the effects of climate-related and other uncertainties in their financial statements. Since then, we've analyzed stakeholder comment letters and held several meetings, including a joint meeting with our sister board, the International Sustainability Standards Board, to discuss feedback on these examples. So, Linda, can we start with you, and could you walk us through the latest developments on this project?
Absolutely. At the June meeting, we decided to finalize 7 of the 8 examples that we proposed. But almost equally important to that decision, we also discussed a few very important points, and I'd like to share that with you now. Firstly, these examples illustrate the reporting of uncertainties in the financial statements by using climate-related scenarios in the examples. So even though the examples are about climate, they can apply to other uncertainties as well, so you could think about it that way. Secondly, we expect that these examples will provide additional insights about IFRS accounting standards that will improve financial reporting going forward, particularly with new insights on how to apply these particular aspects of our literature in today's environment. However, because we are not changing the standards, there's no effective date for when these additional insights need to be reflected in the financial statements. So on the one hand, we would expect that companies will be entitled to sufficient time to consider the examples, and some of our board members have noted that companies need time to understand the examples, draft disclosures, and work with their auditors. But at the same time, we expect that changes would be implemented on a very timely basis. We expect that for the most part, the examples reflect disclosure of information that would already be available to support recognition and measurement in the financial statements. And finally, we plan to issue the final examples in October, but to help our stakeholders get an early sight of what is coming in October, we plan to publish a near final draft in early Q3, and we'll definitely let you know once that's available.
Thanks, Linda. So let's move on to the second project we wanted to cover today, which is financial instruments with characteristics of equity. And as a quick refresher, financial instruments with characteristics of equity, or FICE as it's often called, aims to clarify the often blurry lines between financial liabilities and equity on a company's balance sheet, especially when looking at hybrid instruments. So those are instruments that have characteristics of both debt and equity. Hagit, can you give us a reminder of the project's history?
Yes, of course, and FICE has an history indeed. So late in 2023, we have issued an exposure draft proposing clarifications to help companies apply the principles in IAS 32 financial instruments presentations when classifying financial instruments as either financial liabilities or equity. We have also proposed changes to the presentation and disclosures. Since the comment period closed in March 2024, we've been carefully considering feedback from our stakeholders. We began deliberations on 2 topics in the exposure draft. First was the presentation of equity instruments in the financial statements. The second was the disclosures about financial instruments. During the last months, we continued the discussion about potential changes to the requirements in those two areas based on stakeholders' feedback on the exposure draft and taking into account advice we received from our consultative groups like ASAF, CMAC, and GPF.
Thanks, Hagit. So at the June meeting, the board discussed this feedback and made some decisions about those presentation and disclosure requirements. Can you share what those decisions are?
Yes, of course. Let me start with the presentation of equity instruments. Based on strong support, we have agreed that entities should separately present in the statement of profit or loss the profit or loss attributable to owners of the parent broken down into ordinary shareholders, participating right holders, and non-participating rights holders. So profit will be attributable based on the instrument's holders' contractual rights to profit or loss participation as at the reporting date. We will not be requiring equity or other comprehensive income allocation, so the focus is on profit or loss allocation based on rights. Second, regarding disclosures, most notably, we've agreed to retain the proposed disclosure requirements related to the objective and scope of IFRS 7, the nature of claims, terms and condition, and maximum dilution of ordinary shares as set out in the exposure draft, with some refinements. The refinements reduce preparers' concerns about increased volume, cost and complexity of preparing the required disclosures, but still ensure that the disclosure meet the information needs of investors. And third, we made decisions regarding disclosure for eligible subsidiaries. Now, when we say eligible subsidiaries, we mean non-public subsidiaries of public companies that apply IFRS accounting standards. These eligible subsidiaries can apply reduced disclosure requirements as set out in IFRS 19. So this month, we decided to retain the proposed disclosure requirements related to the nature of claims against the entity and the terms and conditions as set out in the exposure draft, taking into account changes to the proposed disclosure requirements in IFRS 7. We had also been considering expediting the issuance of these proposed amendments for the presentation and disclosure so that they could be applied at the same time as IFRS 18, and in this meeting we have decided not to. Part of the reason is that the board's future discussions on classification could affect the tentative decision made this month, and it would be easier for stakeholders if we issue all the amendments at the same time.
Thanks, Hagit. In terms of next steps, the plan is for the board to begin redeliberations on the classification topics that you alluded to in the third quarter of this year. So now let's move on to our final topic today, provisions, targeted improvements. This project aims to make targeted amendments to IAS 37, provisions, contingent liabilities, and contingent assets. Hagit, coming back to you, can you tell us a little bit more about the project?
Yes, of course. So stakeholders have told us that IAS 37 generally works well in practice and doesn't need a fundamental review. However, they've identified problems with some aspects of the standard, most notably when to record a provision for some types of obligations, such as levies, and how to measure long-term provisions, specifically what rates to use to discount those provisions to their present value. With this project, we want to help companies apply IAS 37 more consistently and provide investors with more useful information so that investors can make better assessments of the company's future cash flows. We've published an exposure draft of our proposed amendments in November 2024, and the comment period closed in March 2025. Stakeholders have provided invaluable feedback on the proposals, both during meetings we had held during the comment period and in comment letters. We've received over 100 comment letters, so this is a great opportunity to say thank you for all the stakeholders that send us letters and were willing to meet with us and share their views with us. So thank you from here.
Absolutely. It was a great response, and we're very thankful for that. So at the June meeting, we discussed feedback on the exposure draft proposals. Overall, we're very pleased to say that the feedback was positive. We focused on the three key areas of the feedback. First up is on the proposals is to clarify the present obligation criterion, which is about when to record a provision. Many respondents from various groups and regions broadly agreed with the proposed amendments to this criterion including the proposals to withdraw IFRS 6 and IFRS 21, and they said they liked the expanded decision tree and new illustrative examples. However, even those who generally agreed raised concerns about specific aspects of the proposed requirements and suggested ways in which those aspects could be improved. The main concern is the implications for particular types of levies and the impact of the new proposals could potentially have on different kinds of levies. I think it's very clear from the feedback and the board discussion that not all levies are created equal, and we need to spend some time understanding how best to ensure we have a robust solution. The second topic was the cost to include in measuring a provision. Most respondents agreed with the proposed requirements for what costs should be included. However, some questioned the scope of these requirements. Should they apply only to expenditure on goods or services provided to the counterparty, or should they also apply to ancillary costs like legal fees? And the third topic was discount rates. Many respondents commented on the proposal to require companies to measure provisions using a discount rate that reflects the time value of money represented by a risk-free rate and excludes non-performance risk. Most agreed with this approach, though Canadian oil and gas companies raised concern that it would give them a competitive disadvantage when raising capital in the U.S. market. That's due to a difference with U.S. GAAP. In future meetings, we'll revisit each of the proposals in more detail and consider whether and how to finalize them in light of the feedback we've received.
Thank you, Linda, and thank you, Hagit. And listeners, thank you for listening to this podcast. We look forward to bringing you further updates on these important projects in the future. We are also currently running a short audience survey to help us improve this podcast. Whether you're a regular listener or an occasional one, we'd love to hear your views. You can link to the survey in the episode description. Please stay connected with us through our website and social media channels for the latest news and updates, and we hope you can join us for the July episode. Thank you.
If you enjoyed this podcast, please take the time to rate, review, and subscribe on your preferred podcast player. To stay up to date with the latest developments from the IFRS Foundation, the International Accounting Standards Board, and the International Sustainability Standards Board, sign up for email alerts on our website, ifrs.org, or find us on social media. Please contact us on communications@ifrs.org with any questions, comments, or suggestions.